Great. So I think the last few sessions have been about the basics in terms of approaching uh, the basics of stocks, right? Stock market. So what is a trading account? Demat account is what we discussed in part one. We then discussed a little bit in terms of further elaborating that in terms of how and the basis in which trades are set up. So the type of trades, the type of orders that you can put through into the system, margin requirements, what is margin and the requirements of the margin thereof in the last session as well. So margin requirements and the ancillary aspects related to that as well. And we touch some aspects in terms of how you probably look at some technicalities as far as the stocks are concerned. Now, today's session, we'll do a little bit about financial statements very briefly, not getting into the modalities in terms of critically analyzing that, but just to give a brief in terms of how do we view financial statements and why financial statements are very, very important, and the basic aspects of reading of some elements of balance sheets or profit and loss, as the financial statements are called, right? So you ladies are anyway superlative, right? When it comes to managing finances at home, that is what I've always maintained. That is what I've seen in my house as well, and I'm pretty sure it must be in your house as well. So managing finances, inflows and outflows, that is what balance sheet and profit and loss is all about, right? So managing your expenses vis-a-vis what kind of revenue streams are coming through, what kind of income is getting generated, so that you also save a little bit out of that. You also expend or have your expenses done in the right areas which are required, and therefore maintaining an equilibrium in terms of both the expenses percentage as well as maintaining an equilibrium in terms of how assumptions are drawn in terms of savings to be done for future requirements as well. So I think financial statements are nothing diverse. I think balance sheet and P&L of corporates move in similar fashion, right? So when a corporate is producing any good or service, it obviously generates a lot of sales. So in financial lingo, it is called as turnover. If it's an asset intensive business, what do I mean by asset intensive? Companies which are in the cement business, for example, companies which are in the real estate business, for example, which are into the infrastructure business, which means building roads, bridges. So they consume a lot of these commodities, right, for building all these activities. So if you need homes to be built, you will have cement, you will have tiles, you will have TMT bars, and all the ancillary requirements related to that. When you're talking about core cement itself, right, it is required for road construction, urban housing, port construction, and it becomes an integral part of that. So when companies start using their assets, this is what is called as using their assets, and therefore when their asset turnover starts improving, how much can they churn these assets? So that is what is basically called as, for all these capital intensive, which means all these industries which require a heavy amount of capital to be invested in machinery, in commodities, in equipments, so that as they start utilizing all these elements of the fixed assets, right, that they have got, they can slowly and steadily generate revenue on top of those assets as they utilize them efficiently. So I think I'll break down in the course of the event on all these aspects as well. So I'll now share the PPT with you guys. So I think great. So any stocks that we'll discuss in the course of this PPT, it should not be taken as an investment advice. It is not a buy or sell recommendation. This is just for having clarity drawn. So there are three main financial statements, as I was saying. There is a balance sheet, which ultimately reflects all your assets, everything that you own, right? Everything that is in your possession. That is what assets are all about, and your liabilities. So I think it is a representation of the financial health of a company on these parameters itself. So assets, anything that you own in your name, and liabilities, anything that is an obligation that you have to pay off, right? So creditors or trade payables, for example, which means that in the course of your business, your payments that have to be done, right, are measured in that form itself. Second is income statements, which mean how the P&L or the profit and loss happens. So when you record your sales, right, I was talking about that just in the beginning in my opening remarks. So when a lot of these capital intensive businesses, once they start utilizing their capital, and then therefore they're called capital intensive because a lot of money or their capital is put to work in terms of fixed assets, because it is of the nature of their business itself. Like I said, cement, real estate, so on and so forth.
हेलो,
Therefore,
हाँ आपने वो ब्लैक पेंट आया है क्या?
and therefore, I think when you're talking about all these aspects, the sales is also called in financial terms as turnover. So what is the kind of sales or turnover that these companies can report? Capital intensive is one. One is service related industries. So what are those? Those are industries like the information technology center or the IT sector as we know it, right? So it is prominently that they are not producing any goods, right? It is all intellectual property. You see all these software engineers write codes, and they work for a lot of corporates across sectors, making all these codes and making applications or apps, cloud, programming, IoT of things, and therefore they make things automated for a lot of these companies. So it's sort of an invisible kind of a thing, and therefore they are called as services. It is not easily touched, right? You cannot touch that like a good or like goods that you produce. And therefore these services that these companies produce, it's more or less based in terms of the bench strength that they've got, the kind of staff that they deploy, and the kind of orders that they get. So this is called as the services kind of, whatever top line that they record is also called as turnover or sales revenue or revenue growth. So profit and loss will basically determine the kind of sales that you got, or धंधे में खर्चे कितने होते हैं. In the normal course of running a household, right? We've also got expenses, as I said, managing your rent, managing your electricity bills, payment given to maids as their salaries, kids' tuition fees, kids' school fees. So all of these are part and parcel of the expenses. So whatever we take into account as our household income, our salary incomes, or our business incomes, or our profession incomes, you obviously have to account for a lot of expenses that there every month, and you need to save that, right? So whatever you save out of the basic expenses that you've got, obviously that becomes part of your EBITDA. Now, we are not businessmen, right? And therefore we cannot claim depreciation and so on and so forth like businessmen can claim. But we do need to pay interest and taxes, interest on home loans, taxes that ultimately that we have to report on the top line that we, or the earnings that we have derived. And therefore the companies also have a similar mechanism as well. So what they are doing in terms of sales growth is recorded as turnover, revenue, or top line, as we call it in financial lingo. The second element is obviously the kind of business expenses that they've got. Rental expenses of running a shop as an example, their staff salaries that they need to pay off, whatever they've got in terms of loan payments or EMIs. If it's a trading business, right, any sub commissions that they have to pay. So all these elements are taken into account before the profit or loss is calculated, right? So if they're making some amount of money, like we save in our households, obviously we're making some profit in terms of business terms. If a businessman or a professional is running that business, and if he's making money after accounting for all these expenses, along with interest payments, depreciation, and the tax, which forms part of EBITDA, right? So what is EBITDA? We discussed that in the first 3 sessions that we had. Earnings before interest, tax, and depreciation. So this probably gives you an indication in terms of how your operational performance has been, right? Because all these elements are taken into account if you have posted a reasonable or a good number, where there is some element of profits, where you can then start deducting your interest payments, your tax payments, and your depreciation to be accounted for. Therefore, the operational capabilities, how good you have run that business. If your sales was 100 rupees in 1 year, if it has gone to 120 rupees, and your expenses from 80 have gone to 90, which means that your top line has grown how? 20%, right? From 100 to 120. But your expenses have only grown by 12 odd %, which basically means that the kind of control that you have on expenses will lead to larger EBITDA, right? So 120 minus 90 will be 30 rupees, while 100 minus 80 will be 20 rupees. So 20% and 30 upon 120 will be almost the same, at 25 odd %, which means that your EBITDA is increased because you've managed to control your costs, and your top line is also increasing, or your sales or your revenue at a decent pace. So I think all these elements are recorded into the financial statements, and that form crux in terms of balance sheets, income statements, and cash flows. We'll go a little bit further in terms of dividing these cash flow statements into 3 parts that are divided, and therefore that will make things a lot more clear. So who uses financial statement analysis, right? So anybody who's focusing on the credit, on the liquidity of the firm. So if the firm or a business or a company is managing its top line well, it's managing its expenses well, obviously what does that mean? It means that your overall leverage or the debt, we discussed that, right? The debt that you've taken to do this business is manageable. Second, because of a good top line or revenue or income growth that you've got and managing your expenses quite optimally and reasonably, you have ensured that the business prospects in terms of EBITDA and operational performance and EBITDA margins are consistently improving over a period of time, which gives the business the confidence that the working capital cycle that they are managing, right? And the long-term debt that they're managing. So there are two aspects on the balance sheet also, right? To grow a business, obviously, I think you put in some of your money and you'll also borrow some money. That becomes part of your business or your professional requirements or how a company operates. Some companies are exceptions to these, like FMCG companies as an example, because they've got very, very strong cash flows. And by the definition of FMCG, it means fast-moving consumer goods. So toothpaste, tooth powders, hair oil, shampoos, digestives that we've got, juices. I think all these are consumed at a very, very fast pace, right? And that is required, whether there is a recession or not, whether there is a lockdown or not. All these elements will be required. So if you probably look at information technology where cash flows become strong because they do not have these heavy capital requirements, right? Like buying machinery, buying a lot of these commodity intensive sectors, depending a lot in terms of how prices fluctuate, in terms of raw materials required to make the finished product. And therefore, these companies or these sectors will have superior cash flows. Their balance sheets will have little or no debt at all. And because they throw out cash, which means that the business itself has no leverage or debt on its balance sheet, the top line is improving or is consistent because of the factors that I just discussed, because consumption will happen for FMCG and IT also. I think a lot of invisible in services because of control only in terms of no large overheads except employees, which are manageable looking at their order book and digitalization that a lot of the globe is going through at this point of time. They have their top line or their revenue which is strong, their operational expenses which are absolutely manageable, very, very strong EBITDA margins is what all these companies post. And because even after accounting for interest, because there is no interest outgo on depreciation on their factories that they operate out of, or buildings for IT companies that they operate out of, and even after paying taxes, their profitability improves or is consistent quarter after quarter. So that is what cash flows probably capture in their cash flow statements as well. How much dividends are getting paid out. So I think cash flow also has three components, which we'll discuss. So creditors or people who lend, right, to all the businesses, apart from these two sectors that I spoke about, we'll look at the liquidity. So how resilient is your business? Is there excessive leverage on their balance sheet? We discussed this in the first two parts, if you remember, right? If it is an excessively leveraged company, it basically means that you are always taking debt or borrowings to carry on your business activities. Now, borrowings can be of two types, right? What we discussed. One is long-term borrowings, which is of a longer time duration, and one is your working capital requirements, which is of your short-term duration. How are you able to manage your short-term working capital cycle? What do I mean by working capital cycle? It basically means that how you're efficiently able to manage your payments that you have to give, the payments that you are supposed to receive, and the inventory on your books, how fast it is getting converted into finished products. So the example is that if you produce an XYZ good, right, there will be a process to that. You'll have input costs, then you will start making that good. There is always a work in progress. Some elements of that good that you're making, right, or the product that you're making, there will be a finished product and some processes will be still in work in terms of work in progress. That is what is called as WIP, where the product is still in the process of being converted into a finished good. So you have to account for that because there is a cost attached to that. Now, once that good is done, right, and once you put it into market to sale through your dealers or through your network, there is storage costs involved, there is inventory cost involved till that good gets sold. So there is a time lag that probably happens. And therefore, I think from the periodicity of making that good to selling that good, actually, what is that time lag and how much can you recover that goods in terms of the price on your books? that is captured in terms of debtor days. So if you're transferring it to your dealers, right? And if you say you've transferred 10 items of the finished good that you've made, now the dealer will say that I will now put it for sale at his front end in the retail shop or in the mall or through a distributor network as well. How much of those 10 pieces get sold? They might get sold after 3 days. 4 pieces might get sold after 5 days. Another 5 might get sold after 15 days. Therefore, I think the dealer, once he sells that over a period of time, he will start passing on those revenues that you've generated from that sale to you. So I think how much debtor days or how much receivables that you've got from your dealers, distributors from actual sale that happens is counted from that. How much of an inventory is kept on books, right? कुछ डीलर बोलते हैं कि अभी माल मत भेजो, बहुत माल मेरे पास पड़ा है. I'll give you an example of auto companies. So in the last 3 to 4 months, you always hear, right, that dealer inventory is at 3 weeks, 4 weeks for two-wheelers, 4 weeks. What does that mean? It basically means that if excessive demands come through and there is a huge inflow of demand as well, they've got inventory worth of 3 to 4 weeks with them, which can take care of a reasonable amount of demand which comes through. And therefore, if the manufacturer starts pushing through कि आप और ले लो, dealer या distributor बोलते हैं मेरे पास तो 4 हफ्ते का माल पड़ा है. So now what I want is let this get liquidated. Let this come down to 2 weeks or 1 week. And after that, I will buy more from you. That process is called as stocking and destocking, right? So once he starts buying more, if it comes down to 2 weeks, he'll start stocking up your goods again. While he will wait, right? If there is excessive inventory at his end, at 4 weeks, 5 weeks, he will say, let me destock. Let me ensure that this inventory gets liquidated at my end, comes to a reasonable level. Let it get to those replenishment levels where I can start ordering back from you. Now, this time lag also will ensure that inventory stays on the book of both the dealer as well as your end. And therefore, I think those inventory days are also captured in the working capital cycle. And the third aspect is obviously you need to pay off, right? You have bought material for making these goods and you need to pay these creditors off as well. And they are called as trade creditors, right? So at what time periods do you pay off? Obviously, you need to balance that. If your debtors or your receivables are going to come in 20 days and you pay your creditors in 5 days, you're obviously going to have a very, very tight scenario. क्योंकि वो creditor ने पैसा मांगा, आपने फट्स करके दे दिया है. और अगर आपका पैसा कुछ 15-20 दिन या 25 दिन बाद आ रहा है, तो there is a clear mismatch, right? And if such mismatches happen, you need to borrow more. If you need to borrow more, you put excessive leverage or excessive short-term debt that you need to take to bridge this gap. And therefore, my entire logic of spending time here was to help you understand the entire working capital cycle, which is discussed in a lot of business media. It is discussed in a lot of business publications. And I wanted to give you clarity on this aspect very, very clearly. Who else uses this? Bondholders. They focus on the long-term cash flow. So we just discussed this. So bondholders are long-term investors into the stock, right, or into the company as well. They're ready to lend money with a long-term bias at a good rate of interest, but with the assurance that the balance sheet dynamics and after doing due diligence on all these aspects that we put forth. And last but not the least are shareholders, right? So anybody who owns a stock of a company. We discussed this in the opening presentation that we had. So shareholders, or once you own any amount of stock, even if you own one stock, you become a joint owner of that company or a shareholder of that company. And obviously, I think your focus as a shareholder, where the management focus is also there, right? I think the core management focus is to improve the profitability, cash flows of the company. And as these aspects play out, and as the street, or as we call as the stock market, recognizes and realizes all these facts, there is an obvious upgrade that happens in terms of viewing the stock in terms of valuations and viewing the stock in terms of the stock price itself. Now, what is balance sheet, right? As I said, it is divided into two parts, assets and liabilities. What forms part of assets? So anything that the company owns, right? What is the ownership of that company? Whether it's cash that they have got, inventory, as I said, which is not yet sold off. So work in progress or inventory, which is yet to be sold off to finished goods. Land, buildings, any capital equipment that these companies own and possess in their name. They are all assets of these companies, right? And accounts receivable or debtors as well. So what is accounts receivable? I just discussed that, right? Whatever you produce, whatever is put out for sale, and as that gets sold off, whatever is accountable for you, because you are the rightful owners of where the money should come back to you. Similarly, liabilities, we just discussed all that. Any loans or borrowings that you've taken, your mortgages or borrowings, how much is payable from that? If you've taken non-convertible debentures or bond holders that we just discussed, right? There are bullet payments to be done. What do I mean by bullet payments? So one bond holder is put in money, or there are notes, right, or non-convertible debentures which you raise from the market, because you need to have that element of mix of equities and borrowings, or debt and equity to be balanced out. Whatever interest payment happens in terms of a certain timeline that is kept, after 2 years, after 4 years, those are called as bullet payments in financial terms. So how much bullet payments are expected to get paid off over a periodicity of time by these corporates? I think those become liabilities, because ultimately you have to pay them, right? You have to have that obligation that you have to pay these off at a certain point of time. Therefore, these are liabilities that need to be accounted for in your books and accounts payable, like debtors, creditors. So what we discussed in terms of elements in terms of your raw material purchases, in terms of your in terms of your inventory, etc. So everything is probably done in terms of liabilities and equity, right? So whatever owner's share capital is, what capital the owners or the promoters of that corporate or that business is putting in, and how much of reserves also get accreted to that, along with preferential shareholders as well. So equity shareholders are of two types, right? If you recollect as well. So equity shareholders and preferential shareholders as well. So equity shareholders are shareholders who are owners of the company. So even if we take one stock, as I said, we become owners of that company and form part and parcel of not the promoter group, but form part and parcel of the owners or the equity shareholders of that company. Now, how much of that own promoter's assets are there into the business itself? How much skin in the game, as they call it, does he have in terms of his own money that is put in into the business itself? I think that becomes very, very critical in terms of analyzing the owner's equity as well. Now, assets is nothing but how do you equate this, right? So what is the mathematical formula, if one asks, in terms of how do I define what assets are? So ultimately, assets is nothing but liabilities, and in addition to that, the owner's equity as well. So the resources used to generate revenues are all your assets, right, that we just discussed. So the asset formula is assets equal to liabilities plus owner's equity. So I think this is the accounting equation in terms of how the balancing happens. Ultimately, I think any of you who are commerce students or who had studied commerce, I think always we had this dilemma in terms of matching balance sheets, right? When we were in college, कि balance sheet को match करना है, asset liability का figure same आना चाहिए. And why is that matching happening, right? Or why does that matching happen? Because your assets and your liabilities should match, and therefore the owner's equity along with the assets that you got and the obligations that you have to pay off should ultimately get matched off on your balance sheet, which gives you that equilibrium in terms of creating the entire perspective that the company is planning of. So assets equal to liabilities plus owner's equity. So this might look like a myriad of information, but what you probably got right is what I wanted to show you. So this is the latest quarter number. So any balance sheet that you see or any display that happens in terms of a quarterly update, it's always put out in terms of numbers like this, right? And this is called as a extract of balance sheet, a brief representation on how company balance sheet is supposed to be viewed. So as I said, right, assets divided into two parts, non-current and current. So what do you mean by non-current? Non-current will have everything in relation to what fixed element of assets is there. So property, plant and equipment, right? There is also capital work in progress. I just discussed that in terms of converting this into a finished good. There is some intangible assets which form part of non-current. So goodwill. So if your business is carrying a huge amount of goodwill, what is goodwill ultimately? कि मेरा नाम है धंधे में और वो नाम के लिए people will probably give me a premium or give me a higher price for my products that I'm selling, for the goods that I'm selling. The reputation in my market also ensures that I've got a superior dealer network, distribution network as well. I also have better terms in terms of my creditors. I also have better terms in terms of my debtors to pay me back immediately. And because of my quality of the product, of the goods and the products that I have got, I think I've got a huge repute in the market. So I think goodwill, anything which is untangible in nature, right? Intangible in nature is also accounted for in terms of the non-current assets. I just explained what current assets are in terms of the entire equation when we put out the working capital cycle itself. So any investments that you've got which are of a short-term nature, your cash and cash balances, your trade debtors or your trade receivables, anything that you've given up as loans, right? So you take loans also and you give loans also, right? So I think that is something that is where interest will be due to you. Equity and liabilities, as I said, assets equal to equity, which is the shareholders' capital, plus the entire liabilities. Liabilities are also broken up into two parts, non-current and current liabilities. So non-current is of a longer term nature in terms of your longer term borrowings, your lease liabilities. Lease liabilities means your liabilities that you've taken. As an example, if you've taken equipment on these, and these are not short-term duration, right? For 3 months, 6 months, it happened for 3 years, 5 years, 10 years, your longer term in duration. Anything that you need to provide on your balance sheet. So you would have recognized that banks have provisions, right? Also, there might be certain provisions on certain corporates related to trade receivables. I think some receivables that you've got, they become bust or their businesses actually go haywire and they're not able to repay. So that is also forms part in terms of your provision and other non-current liabilities. Where your current liabilities again become short-term borrowings, anything related to where your short-term payments are for working capital requirements, as an example. Lease liabilities of a short-term nature where you have taken it for a shorter-term duration of time, and your trade creditors or your trade payables as well, and certain other current net tax liabilities or current liabilities that you probably have. So I think this is how balance sheets are formed. My sincere request would be that just have a look in terms of extracts, right? Even if you go on our William O'Neill evaluation page or on an app, in the details tab, right, you will have PDFs of company balance sheets, company P&Ls, and also extracts that you've got on the evaluation page itself. So please go through that once we finish the presentation and today's webinar as well. It will give you a brief on all what we talked about. And this becomes very, very critical because this will give you an element that how the entire perspective of the business from a balance sheet perspective is improving. Is plant getting added up? Are the plant and machinery or capital goods getting added up? Is there an increase in terms of liabilities, as an example? Is there an increase in terms of investments or cash and cash on books on hands? So I think all this will give you indications where if debt is moving higher on a year-on-year basis, mean that the company is borrowing more. Is the top line improving at the same time? We'll have a look at the P&L. But at the same time, I think our cash balance is improving and debt going down, which means that the company is probably doing something right. Is borrowings going down? Are your other lease liabilities, other financial liabilities going down, and your asset balance is improving? Is it getting balanced off, obviously, with the equity capital and the provisionings and the reserves that you've got? However, I think if the net financial obligations in terms of net current liabilities and your net current assets are moving higher, I think there is something right which the company is doing, which your balance sheet reading can give you. And this is the whole purpose why we are explaining this today, so that you get a brief in terms of what you're looking at when you're looking at balance sheets and financial statements. Now let us come to the income statement, right? Now, as I discussed in terms of the P&L, right? Revenues, we've already discussed that. Expenses, we've discussed that. And whatever happens in terms of net revenue is the net income. I mean, net profit or loss is ultimately what? How much top line revenue or income you've generated? How much were your expenses that you needed to put forth? And how much has happened in terms of after accounting for depreciation, interest, taxes, what is the profitability that you are probably looking at? So again, just as a brief in terms of capturing this, revenues less cost of goods sold, right, is the gross profit. So for example, I think if you're making a certain good and there is a certain element of inputs that are required for making that good primarily, I think if you take that out of the equation, you will get your gross profits. Then you have to take out all the other expenses, electricity expenses, rental expenses, expenses in terms of distribution of that product as an example. So anything which is there in terms of the operating nature after that good has been made. And once you take that out, after accounting and apportioning that, for that part or that line of the business, if the business is having 2 or 3 business segments, right? Whatever is accounted for that, and once you take that out, you come to your operating income. So what is that operating income? It is nothing but EBITDA, which is what? Earnings before interest, tax, and depreciation. So once you take your interest expense out, which I explained, right? If you take a lot of companies take leverage, except IT and pharma, IT to a certain extent, pharma and FMCG as a sector. A lot of these capital intensive nature industries will take a lot of leverage or borrowings onto their books. Whatever interest outgo has to be done on a quarterly basis needs to get accounted for. And once you take that out, you'll get your earnings before interest and tax. Earnings before interest, tax, and depreciation. Once you account for depreciation, you will get your earnings before tax, so which is called as EBT or PBT or profit before tax. That is how they put it or display it in terms of financial information. Since you are making reasonable amount of money, assuming that you're making money, right, and the business is profitable, whatever tax bracket that the company falls, and it's a standard element, right? Certain companies with turnover of less than 500 have a lower tax income, while certain companies above the threshold have a certain income in terms of corporate taxes that need to be paid. Whatever gets accounted for in terms of your tax outgo or the obligation on taxes that you need to pay ultimately becomes your net profit or your net loss, either or what the situation is. Third, and the most important aspect as far as financial statements are also concerned, which forms part and parcel of the entire element in terms of reporting, is the cash flow statement also. So it reports how much cash is generated, right? So what I explained right now, how much cash the business is able to generate in terms of revenue, in terms of top line growth. How did the company receive its cash? In what time duration? How did the company use its cash? And also it helps us to understand how much of cash that company is able to generate. Now, there are 3 types of cash flows which form part and parcel of your financial statement reporting. Now, every company has to report these elements in terms of these 3 aspects itself. So, cash flow from operation, cash flow from investments, and cash flow from finance. So what does these 3 elements tell us basically? Cash flow from operation basically tells us how your business is operating right now. How much revenue you are generating in terms of your product or the service that you are making. What are the expenses in terms of making that product, your gross margins. What are the other operating expenses that you've taken out, right? And it helps us to understand the amount of cash that will get generated. Now, depreciation is not accounted for in cash flow statements. Can somebody tell me why? I have kept the mics open. Can somebody tell me why? Anybody? Anybody who wants to answer that or share his views, her views? Fine. So what is depreciation, right? Depreciation is a notional element that is used for accounting the wear and tear on your plant, on your equipment, or on any of the machinery that you use, right? Because anything that you buy, right, you'll put it for use, and that machinery will have a lifespan attached to that. 5 years, 10 years, 20 years, depending on the type of product or machinery that you're using. Therefore, it's something which is not accounted for. It is something that is presumed. So your depreciation, the accounting standard which the Institute of Chartered Accountants has suggested, right? A straight through and a written down value methodology as well. So when you're probably looking at all these aspects related to depreciation, you've got certain timelines that over the next 10 years, I'll write down this asset value to 0. So अपनी जब गाड़ी लेते हैं, as an example, right? When you pay insurance after every year, right? The car value actually starts going down, right? Every year, irrespective whether you use it or not. So if you're using it intensively, I think there is a lot of wear and tear which happens of the clutch pads, brake pads, tires. You need to change your engine oil, clutch oil quite periodically, right? Irrespective of that, I think the value that is derived from depreciation is not something which is actually going in and out of the business in terms of revenues being accounted for, like we sell a good or you need to do those payments off. So there is no hard movement of cash or bank balance statements that is happening. It is a notional assumption. And because it's a notional assumption where the cash element is not involved, therefore it is called as an aspect which probably gets excluded when you're probably looking at cash flow analysis because it does not form part and parcel of that. Similarly, I think any intangibles also do not form part and parcel. Why? Because they're something which are presumed and assumed to have value based on certain elements of business that you're probably applying those values, like goodwill or any of the intangible valuations that you've got, right? So anything which deals with hard velocity of money, right? Where the circulation of money is happening in this entire business activities that are carried on, they are supposed to be accounted for in cash flow statements, and they give you an actual picture in terms of how the actual business is being run on an operational basis. And then therefore the cash flow from operations becomes very, very important. Cash flow from investments, whether you bought additional machinery, whether you bought any additional capital equipment, or you've sold off any additional machinery at your hand, right? So if you sell any investments or equipment that you've got, you'll receive money. If you are buying additional fixed assets, capital equipments, or any of the products for your business needs and requirements, there will be a cash outgo, right? आप कुछ खरीदने जाते हो तो आपको पैसे देने पड़ेंगे, and therefore cash flow from investment will basically be in how much you're investing in assets and how much you are getting if any of these assets are sold. Cash flow from finance is basically any dividend payouts that you've got for shareholders, or any interest that you receive, or any interest outgo that you've got. So it basically gives you a brief in terms of the capturing of all these elements on the different business aspects that I've got, and those are reflected to cash flow from operations, cash flow from investing, and cash flow from finance. Let me now touch a little bit brief in terms of when you look at these balance sheets, right? And P&Ls, a lot of ratios are put forth. What are these ratios? These ratios are nothing but elements for us to understand how the business is probably being benchmarked at that point of time. What is the profitability ratio, as an example? What happens in terms of the aspects related to leverage if you've taken excessive debt on your books? So your debt equity, right? It's always spoken on channels or in business articles. How much debt equity you've got, or how much debt EBITDA you've got. Now I explained EBITDA to you, you know what debt is, right? So how much debt can get serviced at an operational level of a company? If more and more debt is being taken onto their books, how much you are generating in terms of top line will get eaten out and your EBITDA will reduce. Correct? So I think that is nothing but how debt EBITDA is probably supposed to be interpreted. Same for debt equity. In a business, I think if your equity component is shrinking and your debt component is going higher and higher and it's not getting balanced off, it basically means that you owe the creditors a lot more rather than your own equity that is getting pumped into the business. So your own shareholders' equity or own equity of the promoters that are getting into the business is diminishing or getting down, and your other liabilities are probably moving higher, which probably is not a right sign, right? Because then that will probably tell you how your business is probably looked at. Profitability ratio, as I said, I think how your earnings or EPS per share is. That is what is largely accounted for, right, in business media and business publications as well. It basically means it's the same thing, right? It means what we rather discussed a few slides back. How much profitability is the company able to generate consistently over a period of time? And you divide that. What is earnings per share ultimately, right? Net profit upon number of shareholders. So how much profitability is there and how many shareholders are there? Which means how much earnings can you give per share, each shareholder, on the investments that he's done. So that is what profitability will give you. Your PAT ratios or your PAT margins will also be a reflection in terms of whether those margins are improving every passing quarter and year, or they are shrinking, or they are remaining consistent, which will also give us an indication on how the business is growing. If the business top line is growing, but the PAT margin is not growing, which means that there is something where the expense efficiency is not working out very, very well, which basically means that your income is increasing, but your expenses are not increasing in the same pace. So I think all these ratios become very, very important. Liquidity ratios and part and parcel also happen where you need to assess the solvency ratio, right? So the working capital part that I said. So the debtor turnover ratio as an example. How quickly are you able to generate cash from the receivables that you got? Or how much of a delay can you do in terms of your creditor payments? How fast are you able to liquidate your inventory or your work in progress? How fast you're able to convert that and able to sell those requirements in terms of inventory at your dealer or distribution end, looking at the business and the line of business that you're into. Therefore, all these liquidity ratios will help you to understand your solvency perspective of the business as well. And ultimately, I think it's the shareholder ratios as well. So return on equity, return on capital employed, return on investment capital. You would have all heard these terms, right? What do these terms tell you? So how much of equity is invested into business vis-a-vis the debt? How much of capital gets invested into the business? And if I'm investing 100 odd rupees and the return on capital employed says 110%, which is expected, or 10% is an average assumption, means that any incremental capital that is put to use, the assumption is that at least 10% return will come through in terms of that capital that you put through into the business, whether it gets used in terms of further assets that are being put, or adding on to more resources if it's a non-capital intensive company, and how much are they able to use these assets, hard assets or employee assets, by generating more revenue, keeping your costs under control, and therefore returning more in terms of profitability and returning more to shareholders is called as return on equity or shareholder ratios, or return on capital employed, or return on invested capital as well. So what are those ratios? So I think as we discussed, right, assets equal to liabilities plus shareholders equity. Similarly, I think return on capital employed is EBIT upon capital employed. Now you get all these figures onto the balance sheet, right? So what we discussed in terms of EBIT, what is EBIT? Earnings before interest and tax. That is clearly displayed in terms of profit and loss accounts. You obviously get your capital employed in terms of how much investments have been done through your balance sheet. So that ratio ultimately at the end of the day is derived in terms of interpretation of how you've done that. So what is return on capital employed? How efficient your business is before you're paying your interest outgo and taxes in terms of your operational efficiency of running that business upon the capital, or the capital that you put into the business. So how much capital has got employed into the business, both equity and debt funds included in this. So the EBIT upon capital employed will give you return on capital employed. What is gross margin? We just discussed that, right? Net sales less the cost of goods sold. So I think whatever is required for selling that or making that good or making that product upon net sales. What is turnover? Turnover is nothing but the kind of revenues that you've accounted for, or the revenue or top line that you have probably accounted for in terms of the sales that you've done. So the gross profit margin will give you the estimate on how much you're probably making after selling that product and before accounting for a lot of your other operational expenses, including marketing expenses, which come later, right? So sales minus cost of goods sold, gross margins, less operating expense is EBITDA. Less, what comes after that? Less your interest, less your depreciation will come to EBIT. Less your interest payment will come to EBT, which means earnings before tax. And less your tax means you ultimately land at either the profit or the loss. And that is what the net profit margin will give you in terms of a ratio. Similarly, I think in terms of liquidity ratio, right? What is the current ratio? Is your company's current assets for the normal course of running that business or normal course of making those products or goods, they're assets that can be turned into cash at a ready requirement of a year or less. So it's nothing like a fixed asset, right? A bada plant liya, aap bech chhod hi sakte ho usko. It will take time, right? While your cash receivables, your trade receivables are something which can be converted into cash within a year or less. So I think a year is something which has been defined in terms of accounting jargon, and liabilities that get paid within a year or less as well. So how efficient or how sharp your business is to assume that if there is any upturn or any adverse event like we saw in the pandemic, is your business capable enough of generating or has that amount of sufficient current assets to pay off your current liabilities? And therefore, I think it is a very, very good solvency ratio on how liquid or how important your company is in terms of converting your sales, how strong your cash flows are, how you're managing your expenses, and how efficiently you're managing your liabilities as well, your short-term liabilities and long-term liabilities as well. In this context, we are looking at the short-term liabilities, and therefore the current ratio will give us a very good indication if the company is doing its short-term business management, and if it's viable enough in terms of assuming any business risks that come within a time period of a year or less. Ideally, I think what has been taught to us in terms of accounting is that this ratio should ideally be 1:1, and therefore I think it basically will mean that ₹1 अगर आता है तो ₹1 देने के पास आपकी capacity है. We just discussed this debt equity. It is also commonly known, right? What is the financial leverage for debt equity? कितनी debt है और कितनी आपने equity pump in की है business में? कितनी debt आप borrow ले रहे हो? Short term plus long term. Working capital requirement के लिए या for a longer periodicity of the business requirements that you got. So the total liability upon shareholders equity is captured in the debt to equity ratio. A high debt to equity ratio means that it is financing through debt. So I think you need to probably look at that very, very closely, because a higher ratio does not necessarily mean that top line will grow at that same pace. But if your debt is very, very high, your interest outgo anyway has to happen. So whether the company is able to service its obligations is also extremely important. There is also a debt ratio. What does that debt ratio mean? Debt upon total assets. So how many are the assets of the company and how much is the total debt onto your books? If the debt ratio is more than 1, इसका मतलब क्या हुआ? बहुत simple है ना? कि अगर डेट समझो ₹100 है और एसेट्स ₹100 के हैं आपके, व्हाट इज योर डेट इक्विटी डेट रेशियो इज 1. बट इफ योर डेट इज 120 और एसेट्स आर 100, सो आपके पूरे जो एसेट्स है बैलेंस शीट को ₹100 के हैं, while जो आपकी टोटल डेट आपने ली है शॉर्ट टर्म प्लस लॉन्ग टर्म बोरोइंग इज ₹120, which means you have borrowed much more than the amount of assets that you got. So if anything goes wrong, like it happened in the pandemic, right? And your business is shaken for a couple of quarters, you'll not be able to service that debt. If you're not able to service that debt, ultimately it forms very, very poorly in terms of your loss, and you will ultimately be making losses. Also, it forms very, very poorly in terms of your corporate governance as well. Therefore, these ratios become very, very important to critically analyze and observe as well. Now we come to efficiency ratios, right? What do efficiency ratios indicate? The company's ability to generate use its asset. Like I said, the financial term is asset sweating or asset turnover, right? So what does that mean is how much efficiently, how you are using those assets. But ultimately, what does it depend upon? The more the usage of your assets or your inventory or your equipment will basically means that the demand for your products or goods are in high propensity. If that is probably happening, I think you will have a quicker velocity in terms of more and more goods being produced, which means that our assets being utilized far more than other assets for other companies would be. Therefore, I think these 4 ratios, right, are extremely important. Your annual turnover, inventory turnover, which means the cost of goods upon average inventory, or an inventory holding period. How much of your inventory are you holding on your balance sheet in a particular year? So 365 is the number of days in a year on annual inventory. Or your accounts receivable, which means that your net sales that you've done into your average receivable periodicity that you've got, and your debtors period or debtors turnover. As an account receivable is also called as debtors turnover, while collection period is आप कितने टाइम पीरियड में कलेक्ट कर रहे हो, राइट? लाइक वी डू फॉर योर इन्वेंट्री. आपकी इन्वेंट्री कितने टाइम पीरियड में, अगर एक पूरे साल में कितनी बार चर्न हो रही है. सिमिलरली आप कितने बार चर्न कर रहे हो योर debtors as well in a period of 365 days. So these become very, very important in terms of analyzing what are put forth in balance sheets, right? And a lot of the numbers are put forth in balance sheets. The purpose here of this webinar is to help and assist you in terms of you able to now confidently analyze कि ये efficiency ratios अगर मैं देख पाती हूँ, if I am able to see this, now I can see कि अगर collection period बढ़ते जा रहा है, which means that people are taking time to repay, या अगर inventory period बढ़ते जा रहे हैं, which means my goods are not getting sold at the pace that I want it to, right? And this gives you a very, very good indication in terms of how efficient your business operations are, which ultimately get reflected in P&L statements, right? All of this get reflected. अगर कम हो रहा है तो I think top line आपकी बढ़ेगी नहीं. अगर leverage बहुत ज़्यादा ले रहे हो in terms of leverage ratio, so debt बहुत ज़्यादा हो जाएगी. And everything ultimately gets reflected ultimately through the statements as. Ultimately, I think before we end, return on equity, right? It's what basically the return that shareholders expect or promoters expect also, right? By pumping in their own money, by pumping in their promoter equity into the business as well. So I think there are a lot of elements that are probably put into place at this point of time, and therefore return on equity is by dividing the net income that probably comes for the profitability that comes to by shareholders' equity. Now, return on equity, if you can see the formula written in the bottom right, is equal to profit margin into asset turnover into financial leverage. So how much of your profit margins are getting reported? What is your asset turnover? And ultimately, you multiply all these aspects by the financial leverage that your company has taken. And that ultimately will give you the net return on equity, or the net return that equity shareholders derive from the underlying business that they are doing. So I think we are largely done in terms of analyzing financial statements. What are the important aspects that all of you should be looking at in terms of looking at financial statements as well, and the overall aspects related to balance sheet, P&L, and cash flow statements as well. Now, if there are any questions, I think you can put that in the chat box so I can take it. So any questions, you can put it in the chat box. I'll be more than happy. Okay, Ananya has asked a question. In the long term, what capital-based ratio should be one looking at? So Ananya, I think what we discussed right now is different aspects of ratios, right? So ultimately, once you're looking at analyzing a business, right, and what a businessman does or what a promoter does of any company is that he'll ideally like more and more profits to be made. So if more profits are supposed to be made, you'll probably look at efficiency ratios, right? So efficiency ratios will also encompass the leverage ratios as well. So how much is your debt equity? I think is your company able to manage that very, very well. Second, some aspects in relation to how your turnover ratios are, and ultimately I think the reflection probably happens in terms of your return ratios. So return on equity, as we discussed, return on capital employed, or return on investment capital. Therefore, I think all these ratios will indicate and point to us that the business is being run with the objective of optimizing top line or the revenue growth in a fast fashion that is there, looking at business and cyclical conditions as well, managing your costs very, very well, which means that they'll manage their operational efficiencies very, very well, ensure that debt is taken at a manageable level, and debt is required to grow a business along with equity, but debt is at a manageable level, which means your interest outgo also happens at manageable levels, which gives sufficient amount of profits or cash to be thrown out in their book. So ultimately, your cash flow statement will also indicate the kind of cash flows that are getting thrown out from operating activities. These are improving at a fast clip, and dividends are getting paid out. After that, a lot of money is getting pumped back into the business. Means that the business is growing at a very, very fast clip. Not most businesses are able to do that successfully, but most leaders in most leading sectors, as we do at William O'Neill, if they're able to do that and we're able to capture that through our statement reading, I think that can be a very, very positive indication of you being very, very good financial, having your financial acumen go that notch up. And therefore, I think analyzing those statements will make you much better informed investors as Lavina has a question. All the parameters can be positive for any company, despite the fact some shares rise and some decline. So I think all the parameters that I've broadly discussed, Lavina, right, and what I discussed right now as well. Obviously, all the parameters cannot be possible. So I think my whole purpose here was that if there are capital-intensive industries, right, they will have to take debt onto their books. But how are they managing that very, very well, right? Well-managed large companies, even with a reasonable amount of debt on their books, can manage economic cycles very, very well. So what part of your company is in which sector at that particular point of time? As I discussed, right? Pharma, FMCG, IT. There are companies where these are sectors where most companies within these sectors, with exceptions of few, will probably see a lot of cash flows. जैसे FMCG की मैंने बात की, I think वो बेचना ही बेचना है क्योंकि वो goods बेचे ही जाते हैं at that point. IT, very minimal capital equipment that they have, or even pharma to a certain extent, even if they're using those, I think the kind of demand that is there, or the kind of modes that they've got created, will ensure that there is minimal debt on their books. Therefore, I think what we need to then find out is कि अगर top line बढ़ रही है तो क्या margin performance ठीक है? So there is no leverage aspect on all these sectors as well. So are we looking at other aspects of that? When they're looking at probably cash flows, is that happening for these companies consistently? Is that top line growing? Is the profitability margin growing? Is the return on equity or the earnings per share growing at a decent pace for these companies as well? So not all companies, even within that sector, if I may point out, Lavina, and for the benefit of everybody, will have the same growth. So that's why I think that's the beauty, right? I think some leaders within that same sector will outperform because of the modes of their balance sheet strength that they've got, while others keep on struggling क्योंकि उनको जमता नहीं है वो. Their balance sheet is strong, they're not able to take up their business cyclicality, and therefore if you look at even within a sector that you consider, some companies will do exceedingly well, while others on the same parameters will do exceedingly poorly, even if that sector is supposed to do well. Therefore, broadly, I think these efficiency ratios, profitability ratios, and ultimately the leverage ratios for capital intensive companies, I think it depends on these sectors, how you're looking at that. As I said, I think if you broadly have a gauge of this, you will pretty much be rest assured on how you're looking at financial statements per se. Palak has a question: where can we get peer comparison of all ratios? Palak, I think William O'Neill, if you look at our WON site, right, in the evaluation page, Palak, we've very beautifully given a lot of ratios at play. So this will give you a lot of aspects, or the granularity probably that you're looking at on all the aspects that we discussed right now. Great. Any other questions? What I also wanted to ask you, ladies, is the afternoon time better, or do you think that we should do something in the evenings or on a weekend? So if you can give your feedback on that as well. Okay, so I've got 2 responses for evening, weekend. Yeah, Lavina, I remember you had told us the last time you're working. Okay, morning is better, afternoons. Maybe 2 sessions a week will be good. So Samayadda, Yatha, I think what we've done is, I think we've purposely kept this a session a week. The reason here is that you guys will get time after we've discussed all this, right? Just go take some time out, go onto the app at MarketSmith, have a look at all the ratios, have a look at the balance sheets, which you'll get on the PDFs on the evaluation tab. And then analyze that over the next few days. Analyze for a few other companies as well of different sectors, and you'll get a flare of what we are talking about right now, right? Because once you physically get that flare of reading through, I think you'll have things a lot more clear. So there'll be a lot more clarity. I think even if you are going a little bit slow, I think it will be a lot more, it will be fructifying in terms of at least having those aspects done. Okay, I think so. I'm getting a reasonable feedback. So what we'll do is maybe we'll keep it after market hours. Is something like 5 to 5:45 or something like that good enough for all you guys? I mean, the session henceforth after this, or 4:30 to 5:15, 4:30 to 5:30, what, an hour like that. Fine. So I've got a few responses of 4 to 5. Okay. So Lavina, 4 to 5, good enough for you from your work schedule, or 4:30 to 5:30? Yeah, or 4 to 5 is good enough for you? Lavina, weekend, I understand, but the weekend program is a little bit tight right now. So we've already got a few webinars which are lined up and so on and so forth. So I think to accommodate this along with that is becoming a little bit tough. Okay, so guys, what we'll do is you give in your feedback. I think Rucha, Hemal, and the other marketing team guys are here as well. So depending on that, I think we'll look at. I think ideally, I think it's looking at evening. So let's freeze a time for evening from next session onwards. Cool. Okay. So thank you very much, guys. It was a pleasure speaking to you as always. Cases are going up, so thank you again. Be safe, wear a mask, and don't step out of your homes if not needed. Take care.